physical market, and the demand for physical gold and silver sets a boundary on how low they can push it.
Yeah, I think we're reaching that point, and in fact, I'm going to pull up an article.
And make no mistake, this is all being done for the benefit of the U.S. government and the necessity to try and reinforce the dollar's reserve status, which, as we know, it's skating on thin ice now, and that ice gets thinner every day. But you know, they're going to try and kick that can down the road for as long as possible, and part of that has to do with putting a brake on the rise in the price of gold and silver, because when the price of gold and silver rise like it has been rising, you know, up through last August when gold peaked at almost 2,100, and silver peaked at almost 30, it causes the rest of the world to further question the validity of the dollar as a currency. And it's not a valid currency. You know, it's backed by trillions and trillions and trillions of debt. This country has a negative net worth. I don't care what anyone says. You know, if you net out assets and true liabilities, this country's net worth is negative. You know, that's not the basis for a stable reserve currency.
Well, one would say not. And to something you mentioned earlier, here was last week from Craig Hemke in his Sprott Money column. And, you know, he's been wondering, like the rest of us, is anything going to happen on Basel III? I did find this interesting, looking at the U.S. bank's gross short position. I believe this would be for gold. But you see, here's July of 2019, 117,000. This number has been steadily declining. Here's June of 21. So what they're doing, I guess we'll find out soon enough. Although, Dave, the reason we did this unplanned call today, you sent me a message saying, can I check in with Andy to see if he's swamped, because you heard Monex is swamped with buyers. Andy responded, yes, it's flipping crazy, shall we say. Phone has been ringing off the hook since 7 a.m. I said, is that just because the price is hammered, or is there anything else? And he says, hammered price, bargain hunters, I would guess. Manipulations are having less and less effect, it seems to him. Dave, can you share what you've been hearing? Any dealers you've talked to, or anything else you've seen?
Well, I woke up and I had an email from a friend who I've known and been friends with and colleagues with, I want to say going back to probably 2003, 2004. And I personally prefer, you know, SD Bullion or Miles Franklin when I buy metal. But a lot of people like Monex, and Monex is, they're not, maybe the name isn't as well known as SD Bullion or Miles Franklin or whatever, but they've been around a long time. In fact, the current legal apparatus that governs coin dealers was drafted in response to Monex's indiscretions in the early 90s. But so anyway, this guy Mark has I think he said it's a 30-year relationship with this guy at Monex, and he acknowledged, you know, a lot of people don't care for Monex, whatever. And he was talking to him just yesterday, and he said, look, you know, there's a lot of high net worth clients of Monex that are sitting on the sidelines with a lot of cash, just waiting for an opportunity to jump in and buy a lot of gold and silver, you know, when the price goes lower. And I said, you know, I replied, I said, oh, well, you know, please let me hear back, you know, please let me know if you speak to him today. And like within 15 minutes, I got an email. He said, I tried calling him and he sent me a text and all it said was swamped. So I'm certain, just like that tweet that you showed, I'm certain that there's plenty of people out there with plenty of cash. Some of it might even be stimulus check cash. And they've been waiting for an opportunity like this to buy more, you know, basically to stack, right, gold or silver. And let's be clear about something on no uncertain terms. What we're seeing in gold and silver right now is in the paper derivative markets. I can guarantee you, I will bet my full chest of 1 ounce silver pandas, and that's my favorite silver coin. And I got them at a great price. They're 2015s.
So cute.
I will put that on the line. There has not been one real bar of gold or silver that has been sold during this $90 sell-off. It's all in the derivative market. It's all in the paper market. India's dormant right now because of their COVID crisis, and China's been dormant. But at least we think, and the only way we know that is because the gold premiums on the Shanghai Gold Exchange are negative, which indicates they're probably not importing much gold right now. So there's no physical gold, institutional size physical gold trading hands now. The only gold and silver that's been sold over the last 2 days has been from coin dealers to their retail buyers. I guarantee that. So my point here is this is a phony price takedown that you're seeing in the phony paper derivative market.
Well, I appreciate you saying that, because I guess this is really gut check time in the silver market, where you see the insanity in the world, you see what's happening, and that's why I point out what I do and bring on guys like you, at least to share what I'm seeing. It's too bad the CFTC is owned by the banks and has their market policy that tamps down the price voted on by the criminals, JP Morgan and Goldman Sachs. Although, Dave, we won't get into this one today, but could you say that all this is leading to the direct absolute need for the Arcadia Silver Exchange, which you and I have been talking about, which actually irons out a lot of these issues. But we will stay focused today, because I got a few last ones here for you. When you were starting to say, I have an ironclad something, take it to the bank, I thought what you were getting at was that while it's clearly not licensed financial advice, that for anyone who's ever been shopping for silver miner out of the money call options, good Lord, today, that is what I will be doing. And that's the I don't know, advantage, I guess, of being able to just take a step back, and if you want to buy low, sell high, again, I can't give licensed financial advice, but that's certainly, wow, you can get, because not only is the vol going to be crushed on these, but the skew is going to be crushed. So, Dave, well, we'll come back to that next week, perhaps. One last question for you. You had this other article recently that I've been wondering about, Fed's reverse repo madness. The last couple of weeks, looks like all out of left field, the repos are going nuts again. Can you give us a quick bit on what is going on there? Why are they printing money? Do we know, or is it just, can we extrapolate this as a sign that there's some growing stress yet again?
Oh, absolutely. And it's the opposite of the stress that was happening in September 2019 when they started the QE, which is really money printing again under the guise of repo and then term repo, and then eventually it finally morphed into QE with a $3 trillion payload drop of digital cash into the system. In this case, this is no one knows for sure what's going on except the people who are, have a first row seat at the action or are on the playing field. But what it looks like to me is that the banks and the money market funds are sitting on a huge reservoir of excess cash that they have nowhere to go with. And it's, for the banks, if it's in the excess reserve account at the Fed, it's earning just a sliver of a fraction of an interest rate. The Fed raised the interest on excess reserves yesterday 5 basis points. And to me, that's another signal that my theory is probably correct. But at any rate, and also we know that the banks don't have a lot of loan demand, because you just go to the St. Louis Fred database and pull up commercial industrial loans, and you see they've been in declining. And that's a reflection of the fact that the economy is not strong. In fact, it's weak, because if companies aren't borrowing money, it means they don't have any reason to borrow money to expand their business, right? So, but anyway, I digress here. What I think is going on is twofold. So you have this huge reservoir of cash sitting in the Fed excess reserve accounts or in money market funds. And so what happens is, in order for them to try and squeeze out a little bit of extra interest, they might fund repo transactions. Well, there's no demand for interbank borrowing, because that's what the repo market is. It's the interbank lending and borrowing function. And it's dictated by the Fed funds rate. One of the problems when you have too much money like that sitting there fallow is that there's a risk that it's going to push down the Fed funds rate below the target range of 0 to 0.25%. In other words, go negative. So I think, so what these reverse repos are doing, so what a reverse repo is the Fed sitting on treasury collateral, T-bills and whatnot, and the banks and the money market funds, and actually the GSEs are sitting on a big reservoir of cash. So the bank lends out the collateral on an overnight basis to the banks, et cetera. And they in exchange, they put up their cash as collateral. Now, what the purpose that serves is the next day when it unwinds, all of these entities that got the collateral the day before sell that collateral back to the Fed at a slightly higher price. So it basically allows the Fed to build in a higher rate of return on that collateral than the banks and the money market funds would get if the cash was just sitting on their balance sheet or in the excess reserve account. Do you follow me? Mm-hmm. And in a sense of what it's doing is it's draining on just an overnight basis. It takes that liquidity out of the system, and it enables the Fed to maintain a 0 to 0.25% Fed funds rate. But there's also another important thing. It also prevents money market funds from breaking the buck. Now, legally, money market funds are now allowed to break the buck, but it's still really bad optics if they do. All right. And that would just be even more smoke. The reverse repo situation is clearly smoke coming from a fire somewhere in the financial system. And if the money market funds broke the buck, you know, that would fan the flames of that fire, and there'd be even more smoke coming from the cesspool called the financial system. So yes, there is a big problem out there. And, you know, the way we're going to see that problem manifest is in an accelerating rate of price inflation. There's just too much money in the system right now. And the system can't absorb it.
So if we were to say, simplify that to terms easy enough that even a congressman could understand, could one accurately describe it as a giant Ponzi scheme?
Well, that's what the whole US system is predicated on. It's been that way ever since the Federal Reserve was erected in 2013.
That's the box I had checked on my scorecard too. And to part on a wonderful note, can you let folks know if they're tired of having the football pulled away like Charlie Brown every time the Fed does a press conference? Fortunately, you cover all this stuff. Can you let them know what they get at the Mining Stock Journal and the Short Sellers Journal?
Mining Stock Journal is bi-weekly, every other Thursday, and I offer my opinion on what I think is going on in the precious metals market, et cetera. And then I update the current stable of mining stocks, mostly juniors, that I recommend. I also have a section in there where I look for some large cap ideas and offer suggestions for using call options if you don't want to, you know, spend $60 a share for Newmont or something like that. And then if I come across what I think is a table pounding home run 5 to 10 times upside junior mining stock idea, I present that in depth. And all the companies that I cover, I talk to management, either the CEO or the corporate development guy. And there's no monthly minimum. And at some point, I'm going to raise the subscription price. I get emails all the time from subscribers telling me I don't charge enough for what you get. So that's the Mining Stock Journal. The Short Sellers Journal is pretty much self-explanatory. It's weekly. I review the economic data and offer an opinion on what I think it means for the markets and the economy. And then I have short ideas that I cover. Just for the record, I invest in most of the stocks that I recommend in the Mining Stock Journal. I don't take fees at all from any of them. No promotional fees, nothing. Completely independent. I don't even look at Wall Street research. It's garbage anyway. And then with the Short Sellers Journal, I pretty much present only ideas that I either short the shares or buy puts on the ideas.
Well, I appreciate that, Dave. And actually, I know we have a new sponsor to our show, which is BlackRock Silver, which I know you have covered. And I will add, they do support the show and help bring everybody these episodes. Although, Dave, you do not have any financial incentive you receive from them. Is that correct?
That's correct. I mean, it's one of the largest positions in my fund right now. And I think I think it's got a project that potentially means 5 to 10 times more upside from where the stock is trading now. You know, again, it's not guaranteed, but in my opinion, it smells like that could be the case.
Well, I appreciate that. And by all means, folks at home, presented just to look into. Dave, I know you cover it in your journal. And anyway, thank you, BlackRock, for being a part of what we're doing and bringing us today's episode of the show. And with that said, Dave, we will wrap up for today, but thanks for shedding a little light on these different topics, and going to be exciting. We'll look forward to checking back in with you soon.
Thanks. Appreciate it, Chris. Good chatting with you. You got a nice view in the background.
Well, I'm just waiting for you to come on over, and I'll look forward to seeing you soon. Do we have you in the confirmed category as an in-person guest speaker in Silverfest too, Dave Kranzler?
As long as they'll let me on the airplane to fly down there.
All right. Well, we will find a way. Thanks for joining me. We'll check in with you soon, my friend.
Hey everyone, we are live with Robert Kientz of GoldSIlver Pros. I'm your host, Elijah K. Johnson with Liberty and Finance. Again, we are live with Robert Kientz of GoldSIlver Pros. Robert, thank you so much for joining us today.
Thanks for having me, Elijah.
Definitely. Kind of a crazy couple days in the metals markets when we saw this announcement from the Fed that they were going to move forward the time that they're thinking about raising rates. Metals just sold off, and now today alone we're seeing silver down about 5% and gold about 2.5%. Gold is below the 1800 level, and silver made it all the way below $26. Your perspective on what we're seeing in the metals markets right now?
There is a huge sell-off, and we were talking about this prior to the show, looking at the volume numbers. There's a huge rotation out of the predominantly active contract month in silver of July into later in the year in September and some in December. So September and December added together are actually bigger than July. And yesterday, I think Wednesday, we lost 4,300 contracts at 5,000 ounce silver. So a lot of selling, and this is kind of early in the month to do that. We're only on the 17th day of the month. There is this theory out there that gets propagated about the basis of the trade in gold and silver, that as you get closer to the end of the month, you're going to have people rolling to new months, and that would have price pressure, which is true. But I would make the point that when you're unwinding a derivative contract, you're unwinding both a short and long at the same time. And so it's not just the fact that you're rolling to a new month, it's what the relative positions are going to be. It's very early in the month to see this much rotation out of silver. Gold hasn't had that much rotation. It is rolling. The active contract month right now is August. It's rolling somewhat to December, but not nearly as much as in silver. So I think they're different stories. The same thing I see on the COMEX data for gold and silver is that we have settlements wildly lower over the last 2 days, but especially today. So I'm going to go to silver first. Yesterday, the majority of the settlements closed at $27.81. We're now sitting at under a $26 silver price. That's almost a $2 move in settlements on COMEX in 1 day, from yesterday to whatever the final numbers are going to be today. That's astounding. That very, very rarely occurs. And again, it doesn't match up with the rollover. We're not having as much. We're having rollover, but in the middle of the month, I mean, this is an abnormal pattern. This is not typically what you see on COMEX. If I go to the gold volume data, and by the way, volume is up in both gold and silver, which means there's more short pressure on the contracts to begin with. So there's more people coming in, initiating short positions. But if we look at the settlements in gold, Yesterday, the average settlement for August contract was 1861.40. Well, we're sitting at like a 1771, 1772 gold price. That's a huge difference. So essentially what's happening is there is translated, we're in the middle of the month. We shouldn't see as much roll as we're seeing in silver. We're not seeing that much roll in gold. So it has nothing to do with that basis, co-basis argument that some commentators make. That doesn't explain this. When you have this in the middle of the month, what it is people hitting the futures with a ton of short interest. That is the only thing it could be. And what is the driver of that? You mentioned the Fed. The Fed may bring forward their interest rate hikes. Okay, fine. That should be bullish for gold and silver, because what happened the last time the Fed hiked rates? We had a 20% negative correction in the stock market. I believe that was what, Q4 of 2018. That backfired on the Fed. And so they then had to ease. So when you have a market addicted to low interest rate debt and you threaten to raise rates, that is usually a sign the economy is going to slow down. There's less debt available. The stock market's going to correct when that actually occurs. So why wouldn't that be bullish for gold and silver? So nothing in the physical mechanics of the markets explain what's going on in gold and silver other than the fact, in terms of contract rollover, it's more of the fact in the middle of the month they're getting slammed with short paper. It's blatantly obvious on the charts. And there's nothing about what the Fed said that should be extremely bearish for gold and silver. It makes no sense. It's a contrary, the market is acting contrary to the way it's always acted. And the only way that it acts contrary to the way that the market usually acts is you have big players coordinating for that to occur. Because the rest of the market on a pending rate hike is not going to slam gold and silver. They're not going to exit their gold and silver positions or sell short paper on the COMEX. It just doesn't make any sense.
Now, kind of to that point, now just to remind our viewers who are just getting in, we're with Robert Kientz of GoldSIlver Pros. We're seeing as we speak gold and silver plummeting. They're down, silver's down about 5% today. Gold's down around 2.5%. This is the continuation of the sell-off we saw yesterday. And people are actually commenting in the comments that, you know, the title of this video, sell-off in metals, might be a bit misplaced, because as you're saying, it's like, well, what is actually happening? Are people actually selling metals, or is this just manipulation? And if people are interested in learning more about the manipulation debate, we have a link in the description of this video to kind of get all perspectives on that. But I would like to get your perspective on this, because we've been seeing really throughout the last couple, this year and last year as well, when we've seen extreme demand for physical metal on the retail side, you know, like at Miles Franklin, Andy Scheckman points this out so much that we're not seeing people selling. We're not seeing almost no people selling, but we see these, you know, dramatic decrease in the price. So your perspective on what is really going on? People aren't really selling the metal, are they?
No, I mean, if you look on the, so let's start at the COMEX. If you look on the COMEX, June has been a big delivery month. I'm looking at the year-to-date delivery notices from NYMEX right now, and it's 22,229 contracts, which is the fourth most delivery this year on a monthly contract, and we're only slightly over halfway through. So we could get to the 30,000 number in terms of delivered contracts. Now, silver, not quite as many deliveries, but gold has had very robust deliveries. And then, like you said, if you look at the retail numbers, we're having shortages of available gold and silver, which is why we have the premiums. So I don't think people are selling their physical gold and silver, definitely not the retail crowd. And they're taking it off of, they're taking gold at least off of the derivatives market. So again, I don't think a physical dumping of gold and silver to this market really is the explanation. And when you understand how spot price is determined, we know that for a fact, because spot price is determined by the derivative markets. It's the collaboration of the London OTC market and the COMEX. And the reason I say that is because the COMEX very closely mirrors the quote unquote spot price that you see. And we've seen all this collaboration between the London market and the US market. So we know that they collaborate on products. You know, they have the EFP mechanism, they have the 400-ounce bar mechanism. And so the markets closely follow each other. So spot is determined by the derivative market, not physical selling. So this, but if you read the financial news, they'll say gold is selling off, silver is selling off, and people don't know the difference between the physical and the derivatives complex. I think people that follow your channel know the difference. But that's a big part of what we do, is to educate people as to how spots actually determine, and the mechanics of the price rises and falls are more determined by the derivatives. Now, a big delivery month on COMEX can cause interest in the metals to increase, and that will be reflected in the derivatives, but that's usually an after effect. But when you see a sell-off like this, it very rarely ever has anything to do with the actual physical movement of the metals in the market.
I think that's such a good point, and that's kind of what I was referring to, is the physical selling for the retail side, that we're not seeing a lot of that. Now, with respect to kind of, you mentioned the interest rates, right? How the Fed has been saying, well, we might raise interest rates far in the future, but they kind of brought that time horizon forward a bit. Mm-hmm. Now, you said that should actually be bullish for precious metals. A lot of people argue that gold, especially, is negatively correlated with real interest rates. So, and that's like the greatest correlation there that you could possibly have. So yes, it seems like it would actually be bearish in that argument if you go by real interest rates. But your perspective on that?
It is typically. So if you chart, the biggest predictor of gold price is going to be real interest rates. And that is the interest rate, minus basically the value, I'll say the value of money. So if you get negative interest rates, if you get a negative net return on your money, yes, it is over the long term. However, in the short term, people take other factors into account. They take into account the health of the economy, what the interest rate's going to do to the bond complex, what the interest rate's going to do to corporate America. And especially, we have to be careful, Elijah, looking back at 30 and 40-year-old data to now, because we're in a different stage of the life cycle of the US dollar and the debt system, where you have rising rates with this much debt outstanding, record levels of corporate debt, record levels of personal debt, record levels of government debt. Rising interest rates are a threat to the solvency of that entire system. And the longer term, that should be bullish for gold and silver. And a lot of analysts understand this. So could some of the selling pressure in the derivative markets be because of the inverse correlation of gold price to expected interest rates? Sure, but not to this amount. I don't think it is. And people who understand or have questions about the solvency of the debt-based system and what a rising interest rate could do to that, I think, when you have that longer term view, you have to look at this as, buying opportunity if you're in gold and silver, because I don't, unless this is a coordinated action to tamp down the gold and silver price, I don't see this lasting. I don't see this price drop lasting, because people are going to start figuring out, wait, if we raise bond rates, what if the 10-year bond rate, rises half a point eventually? What if mortgage rates rise from record lows and we start getting 4, 5, 6, 7%? What's that going to cause to housing prices? Housing prices have to fall. Okay, housing prices are inversely correlated to the cost of servicing the loan. Then you have to look at the federal government. If you raise interest rates, the cost of that debt gets exceedingly expensive. And how do you pay for it? You have to take on more debt because it's not in the budget. We're running a potential $6 trillion deficit. That's what the Biden administration wants to run, a $6 trillion budget deficit. So where are you going to get the money to pay extra interest costs on the US debt? You don't have it. You're going to have to borrow more. See, we're now at a point in which that system is not going to work anymore. So yes, negative interest rates are negatively correlated with gold price, but you have to take it in context of where you are in the economic cycle and what we've seen in the past. And so if gold and silver price keep falling like this, then it has to be some sort of manipulation, because especially bondholders are very wise and they understand the impact of interest rates. And the market traders are going to consider the long-term implications. That's what I would say. When you're looking at derivatives markets, you're looking at people with a lot of financial information. This isn't the retail trader. You're looking at derivative markets. This is the big wealthy family houses. This is the hedge funds. These are the bullion banks. These are not stupid people.
No, kind of getting into that with respect to, we're seeing the prices fall. And for those just joining right now, we're seeing gold down about 2.5% today, silver down 5%. It's below $26 today, and gold is below $1,800. So kind of your perspective, does this change the long-term bullish trend for gold and silver?
No, not really, because when you looked at gold, the most prevalent pattern from 2011 was a cup and handle. And I've said it could retrace all the way to high 1600s and still be within that bullish formation. And we never got down to high 1600s after the last high in gold last year. So it's still within a bullish pattern. But also if you look at the fundamentals, the derivative markets can drive gold down to whatever they want in the short term, but the fundamentals eventually are going to overtake it. In silver, it's such in demand industrially. It's beneficial for the economy to keep a lower price until you don't have any silver left. And then all of a sudden that has to snap back. And we're getting close to a point in which there's not enough available silver at this price. Yes, there are hundreds of millions of ounces stored in investors' hands, within the derivatives complex itself, within the depositories and in private hands. But to get that silver out, you're going to have a much higher silver price. See, that's the way that works. It's supply and demand and price. People aren't going to give up that silver at $26, $27. They're going to hold it. So the long-term factors in gold and silver are both bullish. So I've stopped worrying too much about short-term price movements, other than in situations like this where it seems counterintuitive. I really look more at the long-term supply demand fundamentals, and then I look at the economy, and that's what drives my decisions. And so I'm not going to plan on selling any of my gold and silver. I'm going to hold it, because I think the ultimate value of gold and silver, when we get to that ultimate value case, they're at a much higher price level. And I don't think that that's 10 years from now. I think it's a lot closer than that.
I think that's such a good point, how really to look at the long-term horizon for gold, and the fundamentals still seem very bullish. One of the things that people are commenting in the comments here, and yeah, to our viewers, everyone watching, if you do have any questions for Robert you'd like me to ask, just type them in the comment section right there, the feed you see. Now, with respect to what are the fundamentals for gold, Basel III, there's some questions on that. Your perspective on how that will impact gold and possibly silver going forward.
So what I have said about Basel III is there's been a wide range of commentary. So I've had different people on my program. Andrew McGuire came on our program. We premiered that last night, and he thinks Basel III will forever alter the landscape of gold, because he says, Robert, you can't unwind all the derivative unallocated positions in the London market without consequences. True, there are 4 big banks there that trade that could have consequences to those banks. There could be big losses. How that affects the COMEX. The COMEX is a different market. We've seen a report by the OCC that they aren't in compliance with Basel III from the gold end. So, and we haven't seen, a big movement there. On the other hand, I had David Morgan on my show last week, and he said, well, I've talked to people in the gold industry. They don't think it's going to have much of an effect, because he thinks that people have prepared for that. And they have done what they needed to do. They've already, taken the other side of that or unwound their positions. Whether that's true or not, we're going to see. I've landed somewhere in the middle, because the way that I look at it is, to me, it's not just the requirement that to consider gold as a high quality asset on your books, it has to be real gold allocated and hedged, which is what Basel III requires. So unallocated doesn't count there. It's not just that. It's the fact that we're seeing a change in regime about the way gold is valued in the financial system. And a lot of these, what I call unallocated or derivative products, are going to have less value in terms of banking liquidity and the value of a banking asset. And not only that, but I think some of the gold trade is going to come out of London. So the second order effect is, where does that gold trade move? If the unallocated market, if the banks have to exit it, where does that go? Does it come to the US? Does it go to Shanghai? So in the short term, bullish of gold and silver for those reasons, because it's going to be more about the real gold than it is the derivatives. But eventually that trading moves somewhere. That's the second order longer term effect. Where does that trade move? Who absorbs that trade? Who becomes the power center in gold? And that's probably the bigger question long term. Who controls the gold? Right now, it's a collusion between the LBMA and the US markets. Who's going to determine gold price in the future? That's, to me, a very, very big question that nobody has really sought to answer in the gold community. I keep asking and nobody's providing me an answer. But to me, that's the big picture. What happens? Who controls the gold price? And therefore, are we going to go back to a multipolar market with many small markets where we're actually trading physical gold, or is another sort of derivative going to emerge? And if so, who controls that derivative?
Now, some people are saying that Basel III will really end the manipulation in the gold market. And like I said, if people would like to learn more about the whole debate surrounding whether gold and silver are manipulated, they can find a link in the description that gives a playlist with all the perspectives. But your perspective is that gold is manipulated. And I guess Basel III, will it end the manipulation in gold?
I don't think it's going to end the manipulation, because it's not going to take out all of the manipulated markets. And I don't think it's going to destroy all the manipulators. I think that the manipulation may move through different channels. I do think there's going to be adjustment there. And I think short term, that's why I'm bullish on all of the precious metals, gold, silver, platinum, palladium, because they're all traded in London, by the way. This isn't just about gold, it's about all four. I do think I'm bullish on those metals for that reason, because to Andrew McGuire's point, and Alistair McLeod, who's been on this channel, yes, they've got to unwind all those positions, and that's going to have an effect. But I hesitate to think that the bankers, which developed the Basel regulations, are going to destroy their own balance sheets to let us have free gold. No, I think there's something else going on, and I think we have yet to see what they're going to do.
So moving forward, how do you think manipulation would play out after Basel III?
Well, definitely it's still going to be on the COMEX markets, because I mean, you can manipulate. You're looking at what's going on right now. You're looking at all the short paper being dumped on COMEX. It's blatantly obvious that there's a new additional paper at a lower price point to the tune of gold like $90 in a day and silver almost $2. That's a good way to do it. What happens to the London market, I think, is yet to be seen. I'm not one that thinks the OTC market completely goes away. I think it has a higher cost structure. It becomes less liquid, maybe less banking participants, but it's still going to be there and it's still going to serve a function. I do think the manipulative pressure will be eased for a while, and that will allow gold and silver to rise due to more physical demand and fundamental demand characteristics. But again, I'm not 100% convinced that the powers that be are going to let it run completely to, what some people call 10,000 gold and, $600 silver. I don't think that we're losing all of the manipulative factors that's going to happen. I do think that we're going to hit a new plateau, a new stair step, or a new bottom, if you will, on the gold and silver price. But again, I'm going to be watching these other markets to see what happens. What we in the Western world tend to focus on is the Western world. There's the rest of the world. There's billions of other people in other countries and billions of other, there are plenty of other markets which would like to grab hold of that gold market. And there's going to be incentive for them to control it, because at the end of the day, gold is the ultimate asset in the financial system. To think that's ever going to be 100% allowed to trade freely would take a worldwide revolution from the people's perspective and understanding the value of gold. I don't think we're quite there yet. I think what we're going to see is more push for less derivative traded market pricing structure. But I don't think that people that have an incentive to control that price of gold and silver are going to let it completely run free. I do think that the gold market will be democratized to an extent. It's not going to as much be dominated by the Western powers as it has been.
Now, for those just joining us right now, we're with Robert Kientz of GoldSIlverPros.com, and we're seeing gold and silver sell off today, or fall, depending on whether you think it's real selling or not. Gold is below 1,800, silver is below $26. Now, this viewer is wanting to know, Leon is asking, gold or silver? So as we see gold and silver fall, silver is falling more, so it seems like a better buying opportunity for silver. Your perspective?
Yeah, I would say in the short term, more bullish on silver because it's used both industrial as an investment. I think we have extreme investment demand at the same time that the world needs a lot more ounces for industrial purposes. So from a fundamentals perspective, silver has the higher short-term upside, but silver tends to move after gold. So you probably see the gold price move first, and then silver will follow. Traditionally, if we're going by traditional correlation between the gold and silver, gold will move first, silver will pick it up, and it will move up more violently. Silver tends to be more speculative. So from the perspective of gold or silver, it depends upon your investment time horizon, your risk appetite, and things like that. I can't make the decision for people. You have to make it for yourself. But the basic factors are silver moves after gold. Typically, it tends to move more violently, but it doesn't stay in one position for long. It can move violently to the upside. It can move violently to the downside. I would say from a fundamental perspective over the next few years, they both will continue to move up. There will be less volatility in gold, a little bit more safety from a price perspective, but there's higher gains to be had in silver. So it's really up to each person to decide what makes most sense for them in their investment portfolio. If we're going to a financial collapse scenario in which we think the whole house of cards of the financial market is going to collapse, like I wrote in my book, I do think it eventually is going to. That's the drop shadow. If we get to that point, then hey, pick one, because they're all going to go up. Things like farmland are going to go up. Any physical asset which has value, has traditionally been valued, is going to go up. And so you couldn't go wrong either way.
Sarge is wanting to know, why are countries repatriating their gold? And if you had any updates on kind of the latest revelations with respect to that.
Yes, countries are repatriating their gold because traditionally it's been stored in either London or New York, and we suspect, like I interviewed Nick Bereschiff, of the CEO of BMG Group, who runs a gold fund up in Canada, and he was looking at the authorized participant documents and all that stuff of when GLD and SLV first came out, and to give the brief version of this argument, he believes the central banks were leasing out their gold and it was going into things like GLD to give GLD liquidity. And he thinks they were, leasing out gold to other interested parties like the exchanges as well, to create a false sense of liquidity. Because if you report a certain amount of gold held on your balance sheet, but you're actually giving it to someone else, it creates a false sense that you still have all of that over here. So it inflates what people perceive as actual ounces available. So essentially, we have a situation which I think some people have figured that out in Germany, Brazil, Hungary, and everybody wants to get their gold. I think they're realizing how much each ounce is rehypothecated or put into a paper contract on top of that, many times what we actually have in gold and silver. And I think they're wanting to get it. If you look, Hugo Salinas Price, Mexican billionaire, recently wrote an article and said that his informants told him that China and Russia had threatened to peg their currencies to their gold holdings. And that's why some of the Basel regulations came about in the first place. In other words, he believes there was an incentive given by Russia and China to the Western gold markets to clean up their act. And if you look at what we suspect that that Russia and China have in gold, when you take their sovereign wealth funds, and for example, where they're stashing gold, and they've said that they're doing that, this is out in the news. We think they have many more tons than what they officially report at their central banks. And so we took that to mean, from Hugo Salinas Price's report, that Russia and China know that they have more gold, and that they know that the West has less gold. And that's given them power in the financial system to say, we're not standing for this petrodollar regime anymore. We're going to exercise our authority in the financial markets. And so you see what's happening. You see now Basel III, you see the potential de-emphasization of the London and the gold market. You see Russia and China threatening to back their currencies with gold. What's happening is power in the gold markets is shifting west to east. It's very clear. And these are the signposts along the way that we see. And other countries are picking up on that, and they're trying to repatriate. I think all the central bankers of the world and all the finance heads of the world know what's going on. They're not going to tell the public and panic the public, but they know what's going on. And so now you're seeing those gold flows. You're seeing people say, ooh, I better get my gold back.
And it's interesting because we're also seeing a lot of inflation, and that spells bad news for the dollar, right? Now, I wanted to get your perspective on that, and kind of to wrap up, kind of on the Fed's decision, your perspective on this, because the Fed didn't really make any concrete decision yesterday. They just said, well, we might raise interest rates a bit sooner. So it seems like they are looking at the inflation, the skyrocketing inflation we're seeing, and saying, well, we might raise interest rates sooner, but they're still not making any concrete decision at the moment. So your perspective on that, and the inflation you expect in the near future, is it going to be transitory as the Fed is saying?
So the Fed here, all they have to do is release a press report or have Powell say something, and it moves the market. The reason is, Elijah, because we're a financialized economy. It's not a value economy. It's not a product economy. It's an economy that lives on debt. And the lower the interest rate, the bigger the multiple you can get, the more money you can make in this market, the higher interest rate, the opposite. So what Powell says in terms of interest rate movements and what the Fed says that they're going to do with the central bank, that's the money spigot. And as you affect the money spigot, you affect how the economy reacts. So all they have to do is say, we might do something at some point in the future, and it's going to move the market. In fact, the markets will price in what they think the Fed is going to say prior to, and the Fed says something other than what the market thinks they're going to say, even though they don't actually do anything. They just, oh, we could do this. You'll see this market movement. And that's the power. The Fed has way too much power, but they have too much power because everybody's addicted to the money spigot or financialized. You cannot get out of it. So my thoughts on the Fed are, they have to be careful what they say, but they know that what they say is going to affect things, and they will say them at certain times to affect a certain outcome in the market. Now, I would say that the Fed's ability to do that itself is transitory, because yes, they're going to release a statement now, but the market's going to adjust and then it's going to go back to business as usual. And so that effect is short term. If the Fed actually raises rates, just expect we'll have a stock market crash. Just expect we'll have companies start to complain about their debt load and not being able to service that debt. Expect the government auditors to say we can't pay this debt, it's unsustainable, interest rates are rising. Expect mortgage rates eventually to rise and other rates to rise and the economy to slow down because people can afford less mortgages and cars and things like that. He can say whatever he wants. If he actually does it, that's what you have to watch out for. If they're stupid enough right now to raise rates, they just have stopped whatever economic recovery we may have had. And I don't think, depending on how they raise rates, I don't think it's going to stop inflation. When you look at what Paul Volcker did, we had much less debt in the system. We had much more savings in the system. We had a much more stable economy.
So we could take a look at the price and volume chart where you see massive spike of volume here, right at the exact time the price coincidentally falls. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on a Monday afternoon. Interesting day in Silverland because, as you'll see, I'm going to pull up the chart here momentarily. Once again, there was some spoofing early in the morning, a very unusual looking pattern here. And what happens is that for any of the bank's customers who had tried to protect their downside and placed a stop order, so if they were long COMEX futures, they got stopped out, which means they were forced out of their long position. And then down here, which allows the banks to escape their short positions ahead of Basel III or whatever else may be coming in our near future that the CFTC is doing its best not to be transparent about. But that's why Silver Chris is here for you today. And before we dig into this one, I would like to mention this video is sponsored by Silver Viper, one of my favorite silver companies, and nice to see they're pleased to announce the company has filed on CEDAR 43101. So technical report for a previously announced La Virginia project Maiden Resource. This is run by my good friend and one of my favorites in the mining industry, Steve Cope. So link to that is in the description field below, and you can find out more about the technicals. Fortunately, things going quite well there. I can't even imagine how well things will be going for Silver Viper after some of this pressure is resolved, because when you spoof the price and cheat people for 30 or 40 years, certainly, they get a little frustrated from time to time. And that's why I recorded a video coming out later this week about the legal options that are available. They're bigger than you might imagine. And anyway, silver there dips down, then shoots right back up. It's exactly what former Commissioner Bart Chilton described when I asked him if my interpretation of the mechanics of how the manipulation is actually executed occurred. And sure enough, not only did he say it was a really good description, he said the only difference between what I said and now is that because there's so much leverage in these markets, when it happens, the moves are even bigger. But of course, I know that sounds like pure alien hunting conspiracy theory. So we could take a look at the price and volume chart where you see massive spike of volume here, right at the exact time the price coincidentally falls. And if, we'll find out again later this week, If you want to submit a Freedom of Information Act request to the trading records there, or find out what Deutsche Bank or JP Morgan were giggling about as they screwed their customers, or let's be fair, it might not have been JP Morgan or Deutsche Bank on this particular spoof screwing their customers. There's a whole bunch of banks that do this. And since the CFTC is suppressing the evidence that has been sent in and the trading data, that's why I'm excited to start getting some of those request acts out soon. Because at least the positive is that, for me anyway, there's no longer any mystery. The evidence is clear. There's a reason they refuse to talk about it. And, you know, that's okay, because now it's time to move on to stage 2, which if you hit the subscribe button and the notification bell right down there, you will find out more about shortly. So now, why would they be suppressing the price of silver and gold? Why would anybody on earth want to do that, aside from making a lot of money? But apparently there must be something wrong with the dollar, because after all that anti-crypto talk, the Federal Reserve, of all people, is exploring a once-in-a-century bid to remake the U.S. dollar. Well, I guess they corrupted the U.S. dollar a century ago when they were invented. But now the rise of private cryptocurrencies has motivated the Fed to start considering a digital dollar to be used alongside the traditional paper currency. Now, I know you think this might be odd, because all the politicians were saying these cryptos could be used for drug laundering and money laundering. Kind of like how the dollar was used by the Clinton and Bush administration, depicted quite hilariously by that fantastic movie American Made. Although, hey, you know, maybe that's just in the movies. It's not like they were sending Oliver North around the globe to sell cocaine and run guns and drugs in a variety of different countries, while Iran was supposedly the terrorist, and they were funding U.S. government funding Nicaraguan rebels. Even despite the Boland Amendment that expressly prohibited a lot of this, which they just lied about and did anyway. So, of course, cryptocurrencies might be a lot more dangerous than that dollar. And of course, who's the biggest money launderer of them all? The Federal Reserve. And that's why they're taking their first step towards launching its own virtual currency. So in case you weren't feeling too safe with Bitcoin or Ripple or Ethereum, now you can get the Fed's digital dollar. And it's gained bipartisan interest from Elizabeth Warren, no less, who talks with Jamie Dimon a lot, doesn't seem to be a big fan. And hey, it is what it is. But it's also sparking strong pushback from those with the most to lose, the banks. And what is the Federal Reserve made up by? The banks. So once again, we are seeing three-card Monty on a governmental level. Not a coincidence that the dollar is unraveling as we speak. My personal expectation, I wouldn't call this fact by any means yet, but my guess is by the end of 2021, a lot of the things that people have been talking about as, oh, one day, I think are starting to become a lot more overt. We'll see what that leaves as our timeline in the silver market. But again, you can see here now, after hearing that Bitcoin was the boogeyman, once again, the Fed taking up, making their own. So is what it is. And I guess maybe we'll one day get commentary from Janet Yellen, who was telling us how dangerous these things were. But why, if it's dangerous, why not make it government policy? Speaking of interesting government policy, here is the United States concerned about strategic metals. U.S. government should invest in nickel refining capacity in coordination with its allies. According to the Biden administration, boy, have they been busy. And the report says if there are opportunities for the U.S. to target one part of the battery supply chain, this would likely be the most critical to provide short-term and medium-term supply chain stability. Now, I didn't see any of the issues with silver mentioned in here. I don't know if it's because the government likes a cheaper silver price, maybe for the military use, where I'm told a missile has 500 ounces of silver in the head of it, so that's a lot. And you're going to probably want to keep the price low if you're building a lot of tanks and guns and things. A little out of my area of expertise, so I won't go off on a tangent on that one. But interesting, the Department of Energy concerned greatly about nickel, silicon, and lithium. So perhaps we can get the word to them about how the banks have been suppressing and cheating their own customers in the silver market, which has really created a real threat to the national security. Because I don't think we need more tanks and guns to defend the United States. We need some integrity in the financial system, which is where the real financial warfare has been occurring. I mean, geez, it's gotten so out of control that even China is releasing metal reserves in an effort to tame the commodities rally. Now, is this actually what China is doing and thinking? I'm not so sure just because Wall Street Journal says so, but it is interesting to me because if you have prices going up because of a hyperinflation campaign, and then they're dumping supply on the market, this is pretty much what I've been reading and learning about in the story of silver, how the white metal shaped America. And anyone who ever wants to tell me about what a great guy FDR is and how we should be thrilled about these things that he did, oh my God, it's a history of let's change this bill to raise silver. Let's change this bill to lower silver. We'll do this against China. I mean, it is what it is. But what you find is the law of unintended consequences. It's the same reason why when Monsanto tries to create, synthetic food, it's hard to improve on nature. Fortunately, nature got a lot of these things right. Is the same case with the financial markets as well. So, China can release a bunch of their metals to try and lower the price. I would consider that market manipulation by nature in and of itself as well. But usually these things have quite a bit of kickback, which I expect will be the case here. Speaking of things with the potential for kickback, here's a story from about a week ago. France's Macron calls for agreement on financial aid to Africa. I won't even claim to know what's really going on behind the scenes of this one, but Macron told a news conference he would like the sale of gold reserves to help finance this planned aid. Now, if you do a little further searching, you'll see there was a whole bunch of shenanigans going on politically between France and Africa right before this came out. And of course, all of a sudden, now let's sell the gold. A lot of central bankers want gold. Governments don't understand it. But Macron, out of left field, wants to sell the gold. I'm guessing it's not really to do great help to the people of South Africa, or I think this was actually Central Africa. But in either case, since a few people have asked about that one, mention it. We'll keep an eye on that. And lastly, because, I mentioned FDR and the Exchange Stabilization Fund, because people say, yes, this technically is legal according to the law code that the U.S. government can go and manipulate the prices. Here, even on the U.S. Department of Treasury, this is their own website, Exchange Stabilization Fund. With the approval of the president, they may deal in gold, foreign exchange, and other instruments of credit and securities, which leaves me confused since Ben Bernanke said he didn't understand gold and didn't have any friends who did either. Yet here we see the president may deal in gold. And an open question to Joe Biden, which I'm sure he will answer and report back soon, but what does he know about gold, and what does it mean to deal in gold? Why is the president dealing in foreign exchange? That sounds a lot like market manipulation to me, which is exactly what it is. And I mean, you can say that the ESF is there, but if you get William Silber's book, William Silber wrote a book about silver, there you go. But you can find out a lot of stuff that really happened that they're not going to tell you about anytime soon, and why I would consider the Exchange Stabilization Fund completely fraudulent and dangerous to the safety of Americans. Yet, nonetheless, these are how things go. But maintaining my pledge to let go of what is and isn't ideal and focus on the solutions. So if you would like to know more about one of the things that, again, can't give licensed financial advice in today's Gestapo regulatory culture, one of the things that I like as a solution to this endless money printing and fraud, Silver Viper, one of the silver indexed assets that, again, this is exploration stock, so there are risks. But to find out if it's appropriate or suitable for you, well, there's a video with Steve Cope of Silver Viper coming your way now. Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. A bit late here in Mexico tonight, but I did just see this headline courtesy of Chris Powell over at GATA, who, good Lord, I think that man deserves some sort of, if they have a Medal of Honor, Jesus Christ, I think that guy's deserved it. There he is sending out that something I don't necessarily know that I'm happy about, but I feel is worthy of being reported. Ex-Deutsche Bank trader Vorley sentenced to a year in prison for spoofing. A former Deutsche Bank trader today was ordered to serve 1 year and a day in prison for manipulating gold and silver with bogus spoof trade orders between 2008 and 2013. And as you see down here a little bit, the prosecution of Vorley and Chenu was part of a U.S. crackdown in illegal spoofing cases since the global market flash crash in 2010. January, Deutsche Bank paid $130 million, and as you already know, JP Morgan has agreed to pay a record $920 million fine. Still unclear. I can't get in touch with the CFTC. I don't know if they've actually paid it. We'll leave that aside for today. One note, and then I'll flip over to the Bloomberg article and continue the rest. This is going to be a short video here, but I don't know. I mean, when I said I'm not like happy, I don't think it's happy news. I don't know. I wish this stuff weren't happening at all. I want it to stop. I don't feel better if someone's in jail or is struggling or in pain. And I understand everybody has their right to feel the way they do. So perhaps we'll leave that at that. But as we continue down here, there were a few other interesting notes in this article. Chanu and Vorley were convicted after a week-long jury trial, which included witnesses describing the bait-and-switch scheme to influence prices and transcripts of messages sent by traders showing they knew what they were doing was wrong. In one instance, Vorley wrote, "This spoofing is annoying me. It's illegal for a start." Now, again, spoofing occurs when trader enters into all this and that. According to Bart Chilton, when you hammer the bids with a ton of paper, drive the price lower in the same banks repeatedly, buy it back cheaper after selling the heck out of it here. Also knocking people out of their stop orders. So that's why you get all the algos kicking in. And then, of course, if you have the ability to let it ride back up like that, I would imagine that would be a spoof. And hopefully the fact that this is coming out today, I mean, I've heard for the last decade that no one since the housing bubble has gone to jail. I'm not sure if this is actually the first person in the financial industry in the last 12 years that's gone to jail. For what it's worth, I want to be careful how I phrase this. I don't know what's going to happen with Basel III, although especially with some of the political and some of the health things that are going around right now and just the way I see things unfolding, I sure we'll be keeping an eye on this. We'll just say that. And anyway, so there you go. And of course, JP Morgan warns of possible return of year-end funding stress. Go figure. They're never far away, but Deutsche Bank trader has been sentenced to 1 year in prison for spoofing. Again, I don't really care if people are going to jail. I care that it stops. Hopefully this is some indication that that is happening so that people are just trying to live a normal life, contribute to the world, and save their money in an honest fashion can be able to do so. So with that said, thanks again to Chris Powell for sending this out. I'm darn proud of you, Chris, for whatever that counts, and honored to know you. And I think a lot of other people really appreciate what you do. And hopefully we're very close to the end. You know, it'll go when it goes. But anyway, that is the news tonight. Hope you're all doing well out there. See you again tomorrow.
Hey everybody, this is Rob Kientz of GoldSIlverPros.com. I'm here with Keith Neumeyer, who's the founder and chairman of First Mining Gold. Keith, how are you doing today?
Great, Robert. Nice chatting. Nice to get this week behind us. It's been a little bit of a crazy week.
It has been. We had the options expiry, as we were talking about before the call, and how that affects the commodities complex. Of course, the precious metals, gold and silver. And then also June tends to be a bit of a weak month. Maybe you can tell us about what your thoughts are on that.
Yeah, it's interesting because if you go back and look at the 30-day chart or the 30-year chart and look at each month and how metals trade, gold and silver predominantly, you'll find that October through February is generally pretty strong period for gold prices, and May through July are really your weakest periods. So we just got to get through the summer here, and I'm sure this bull market that we're well into at least a couple of years of this bull market, which I think is going to go on for another several years. But nothing goes straight up, and this is just a pause, and what's going to be, I think, much higher prices to come.
Yeah. The saying in financial markets is usually sell in May and go away, and typically we'll get a rebound somewhere, as summer nears end. Is that pretty typical for the precious metals markets as well?
Yeah, I think so. It's not a perfect science, and it's not every single year. I remember 2016 was quite a different year, where we started, January of 2016 at $14 silver, and by July we're at $20 silver. So it obviously wasn't the same as it is right now. But we had $30 silver just recently, not that many months ago, and now we're at 25 silver. It's still reasonable silver price for a mining company. Like I run First Synthetic Silver, as many people know. First Mining Gold is not in production, so they're not as affected by the gold price. Their stock price might be affected by the gold price, but their revenues obviously aren't affected because they don't have revenues. But at $25 silver and almost $1,800 gold, these are decent prices. For the mining sector.
Yeah. As the leader of a silver company, I want to get your thoughts on the silver price as well. I don't know if you've been following the silver squeeze saga, what's been going on with Wall Street Silver and that. I just got off of doing an interview with them earlier today. And it seems to me as though a lot of what is happening in the silver market, you see a lot of retail demand. We've got the premiums blowing out on the retail product. Do you think that is, from your view of producing silver, do you think that that's also affecting the industrial side of that market, or do you think it's limited to retail?
I think it's made the industrial side nervous, for sure. I will going to First Majestic because you're asking me about silver. So, and yes, I do follow it very closely. Our stock was one of the stocks that was chosen by the whole Reddit crowd. The share price hit, I think, over $30 that intraday, that one day when things went a little bit crazy. And but what it's done is brought a whole brand new buyer into this market that wasn't there before. You have this millennial crowd that didn't know anything about gold or didn't know anything about silver, and all of a sudden now, with this whole new Green Deal and the whole printing of money that's continually going on, and the millennial crowd, obviously is seeing what the big banks are doing, and how much money that's been made, in a very a small group of people. The concentration of wealth that's been occurring over the last year, I think is upsetting a lot of people. And, this is, the birth of this whole new millennial group, and we call them Reddit or Wall Street Silver. They come under different names, of course, but, Robinhood is another one. But, the industrial guys, they're pretty well taken care of, right? So, the Sonys, the Teslas, Panasonics, BMWs of the world, the big banks know, how much metal they're going to consume, whether it's, gold or copper or silver, they kind of know, right? So if you're, Sony, you're going to put your order into JP Morgan or HSBC or whoever you're dealing with and say, hey, well, I want, 50 million ounces of silver delivered to these variety of ports around the world so we can produce our gadgets, and they sign a contract, and that metal shows up over that year. So that bank is now goes out to the miners and ties up a bunch of the supplies they can, or at least does the deals to fill that demand. And they're good at it. They'll also they manage the price of the metal as well. They go into the futures markets and try to manage the price so that these forward sales that they're doing to the big consumers, they don't get offside on those trades. So it's really very much in their vested interest to kind of keep some stability in the market, so they don't get offside. And then lo and behold, you have this new whole group of people, the retail buyer, coming into this market, screwing up their game, and it wasn't really expected. And I think they're panicking. I think that some of the action that we've seen of late, this invisible hand at $28 silver and $1,900 gold, it's just like every single time both metals hit those kind of magic numbers, they would get slammed, and you just think, oh geez, like this doesn't really look natural, right? Because a natural market wouldn't act like that, right? And so there's something going on behind the scenes.
Yeah, we covered a lot of the COMEX for a long time. I'm a former auditor, so I like to dig into numbers. And we go over the COMEX reports over and over again. We're having heavy delivery on silver and gold the last few years, higher than we typically have had the previous 10. And yet the prices seem to get slammed down. Like you said earlier this week, both of them got slammed down quite a bit. Is there an issue with the derivatives complex and how it's pricing the metals? And if so, do you think that there's any resolution to that?
Yes, there's an issue, for sure. And that's what, unfortunately, but it's not just the precious metals markets. I think it's all markets. Like, look at all the lawsuits that have been against JP Morgan, for example. Just reading an article yesterday that, they've admitted to 6 criminal charges in the last, I think, decade or something. Or maybe it was even less than 10 years, but still, this is one of the biggest banks in the world, getting charged with criminal activity trading markets, and it doesn't matter if it's interest rates or the bond market or stocks or metals. It seems like these banks just they just do what they do to make money, and making a profit is more important than anything. And breaking the odd rule here and there, I guess, if they get caught and get fined, I guess, that they can pay for it because they've just made so much money, and, manipulating silver the way they've done, and gold prices the way they've done over the last, several years. And, they're just, when you can print, an unlimited amount of paper to hold a price in a certain range, and the regulators just sit aside and let the banks just write as much paper as possibly they can without any financial repercussions, the game is fixed, right? Is there a solution? Well, as a miner, I've said to other mining companies, we should try to, form a consortium, similar to OPEC, and price the metals according to what we want to price them at, and so that the mining sector can make a reasonable profit on a consistent basis, so that because the problem we have now, quite frankly, is supply. This whole new Green Deal is going to require a lot of metal. There's just not enough metal being produced to do the things that the government wants to do by re-electrifying the planet in different ways. And it's a crazy situation. So I'm very bullish on prices, and I think oil, copper, gold, silver, you name it. I think everything's going higher.
Yeah, I agree with you. And I think one of the antidotes for that, at least for savers, or some protection from that, is owning gold. And you started a gold company called First Mining Gold. Can you explain a little bit about First Mining Gold and why people are talking about it? I know that you have a project there that looks like it has a really big potential payoff for investors.
Yeah, everyone knows me, for being a silver guy, and I put First Majestic together, which is almost 19 years ago now, and been the CEO of that ever since inception. And 2014 came around, 2015 came around, and I just was looking at these gold equities, these gold juniors, and I was shocked how cheap they were. These stocks were down like 90% in some cases, and even more. So I put this company together called First Mining Gold, and we ended up going out and buying or merging with 8 other companies, and ended up with a decent portfolio of pretty exciting gold projects, mostly in Ontario and some in Quebec, and one in Newfoundland. But so I promised investors at the time, when I put that company together, that if we did ever do any transactions, like selling assets or JVing assets, we would try to dividend out, some, equity or cash or whatever. So we've done a deal. One of the projects is called Goldlund, and it's got a couple of million ounces of gold in it. And it's side by side with another company, a project called Goliath. Actually, the borders are touching, so and it's owned by a company called Treasury Metals. Treasury Metals was trying to buy Goldlund, but I was able to scoop it on them and ended up buying it for First Mining. But so we've, ever since we bought it back in 2015, and we've been in discussions with Treasury Metals on merging these 2 projects together into a single asset, because they should have been together to begin with. Goliath has about 1 million ounces of gold. Goldlund's got a couple million ounces of gold. Goliath is more advanced. They've got permits. So we just figured, okay, well, this is going to really fast track Goldlund to production, and we decided to sell Goldlund to Treasury Metals for a bunch of stock. So we're keeping, First Mining Gold's keeping 20 million shares. We got 43 million. We're dividending out to shareholders of First Mining Gold 23 million of these Treasury Metal shares, plus warrants as well. So there's actually about 11 million warrants. So every shareholder of First Mining Gold is going to get this free share in their account, in mid-July. And it's just automatic. So it's pretty exciting.
So when do you have to be a shareholder by Keith to take advantage of that?
Yeah, right. You can, well, if you're a shareholder today, great. If you're not, you've got a couple of weeks. It goes to shareholder vote. I think it's the 28th of June, I believe, or 30th. But yeah, it's going to be voted in favor. Like, why would anyone not vote for it? Of course, I'm going to be voting in favor of it as a significant shareholder of First Mining. So I'm going to get my free Treasury Metals stock delivered into my account sometime in mid-July. So you have to own the stock between now and the dividend date, which is as I said, mid-July.
Okay. I want to talk about the flagship project you have in First Mining Gold called Springpole, and I wanted to bring up in your presentation the PFS results. I wonder if you would talk a little bit about the value proposition that Springpole brings you and why people should be excited about it.
Yeah, well, I'm glad you brought that up, because despite the fact we're dividending out these Treasury Metal shares to shareholders, we have a portfolio of really exciting assets. The one that you're showing right now is called Springpole, and it's our largest project in the portfolio. But you see the net present value there of just shy of $1 billion. And this is at $1,350, or it's probably $1,600 gold and $20 silver. Obviously, we're higher than those current prices. So, the NPVs, north of $1 billion, and on a pre-tax basis, you can see it's even higher. So it's in the market cap of First Mining Gold is around 200 million. So in one asset, this one asset's worth 5 times more than the market cap of the entire company. And First Mining Gold has a whole portfolio of other assets as well. It's got over $40 million in the bank. It's got $120 million in marketable securities in its portfolio. So it's very well financed. When I took the company public back in April of 2015, it went on quite the ride. for the, by mid 2016, the stock actually hit a market cap of $600 million, and today it's $200 million. And I can tell you the company is in much better shape today than it was when the stock was, 3 or 4 or 5 times higher than where it is trading today.
Yeah. So you have a good cash position. Like you said, you have a project that's worth about 5 times what you're currently trading at. Assume that it's undervalued. What do you think is going to be the catalyst to take it forward? Are you guys doing some additional exploration work? Or are you going to put out a new study?
Yeah, Robert. Thanks, Robert, for asking that, because one thing I think is always a bit of a problem when you have a broad portfolio of assets like First Mining Gold does, is that it gets confusing to investors. They go, what are you guys doing? What are you? And we're going to be drilling, and I think that's going to be a big catalyst. We're going to start drilling Springpole, because currently it's got 5 million ounces of gold, but we think technically from our internal technical people think that there's a lot more gold there than what's currently been discovered to date. So there's a ton of exploration upside there. We're also going to be drilling another project called Cameron, which is also in Ontario, and we're just in the stages of planning that. We also have some joint venture partners on a couple of other projects, like the Pickle Crow project, which is currently being drilled by a partner of ours. And we've also just done a deal on a Newfoundland project called Hope Brook. Then we're getting quite a large stock position in that company, and they're going to hopefully start drilling sometime this year. I haven't got a timeline on when they're going to be drilling. So there'll be lots of news coming out, on the entire portfolio.
So are you and First Majestic invested into First Mining Gold as well?
We are. First Majestic actually seeded the business with me. So when I first did seed financing back in 2014, we put some money into First Mining Gold. We also sold some assets to First Mining Gold, some non-core assets, which they've now turned around and sold to somebody else. But nevertheless, we do own a significant position in First Mining Gold. So we'll get our treasury metal shares as well.
Okay. Do you have other institutional investors invested in First Mining Gold as well?
Not compared to First Majestic. It's a relatively, well, I shouldn't say new company, but it's at that stage where you're not an exploration company, and you're not a producer. You're caught in the middle. And if you look at the way stocks trade, people love to get drill results, and stocks move on drill results. That's one of the reasons why we're going to be focusing on drilling this year, because it's something we haven't done for a while. And so we're going to start we're actually putting a team together right now of individuals who will be monitoring or managing our entire drill programs over the portfolio. But then you've got this development stage company, which is in permitting, which First Mining is trying to permit the Springpole. And that's kind of your most boring stage. And that's where, investors just kind of get tired and, go on to something else. And but the second you get your permit, then all of a sudden, boom, the stocks generally start to move, and then you get break ground and start building the mill, and that's a different cycle. So it's caught in a little bit into that, boring phase. But people are, Springpole is just such a big asset, and we have to focus on it, of course.
Yeah, and I think a lot of analysts, I see reports from 3 different analysts. You have COMEX, Cantor Canada, and H.C. Wainwright, and they all have much higher projected share prices for you guys. So I think the analysts know that you guys are undervalued and have a lot of room to run. And we're not even talking about a rising gold environment. We're just talking about, like you said, at $1,600 gold. So I think the people in the market know it, but it's just a matter of letting people know what you guys have and keeping that interest, in the company, so that people are aware. Beyond that, what is your outlook for gold? And do you think that rising price of gold, if you think it's going to rise, it's going to change things for you when you get closer to, to having that final feasibility study as well? Well,
the gold price, it always helps stock prices, so if we get to the gold prices, I think we're going to get to, north of $3,000 gold. then you know, that's going to be very good for the entire, you know, sector. And First Mining Gold, of course, would react quite nicely to a move in gold to that magnitude. But Springpole, which is the biggest asset that we were just talking about, doesn't need, you know, $3,000 gold. You know, we did the original economic study at $1,200 gold, and then we did another one at $1,300 gold, and we did recent ones done at $1,600 gold. But it's profitable at $1,200 gold, so it can withstand, you know, much lower gold prices, which I don't expect we're going to see. But you know, this is a highly or will be a highly economic asset.
Yeah, highly economic, and any rise in the gold price goes straight to the bottom line, essentially, because you guys are in a positive position from a all-in sustaining cost, mining cost position, right?
That's exactly right, and that's what's beautiful about the miners. So, you know, the leverage that mining companies have. You know, because your fixed costs generally don't move much, right? You know, maybe there's inflation and maybe there's some wage increases, but you know, usually what happens in a bull market is the metals far exceed any kinds of cost creep that comes in, and so the majority of that extra revenue just drops right to the bottom line, as you said.
Any other last thoughts on First Mining Gold that you have for us today, Keith, that we haven't covered?
Yeah, just look for drill programs to start. You know, look for some news coming out of our partners, you know, regarding the Hope Brook project and the Pickle Crow project. You know, there could be some other deals also in the making, but you know, in my opinion, the stock is, you know, quite cheap. You know, it's about a third or about a quarter of what it was a few years ago. And with this spin out, you know, coming from Treasury Metals, you know, the Treasury Metals trades around 90 cents a share, and you know, if you own 1,000 shares of First Mining Gold, it's about a 10% dividend equivalency. And I say about because you have to go to the calculator, and on the date of distribution, which let's say for argument's sake is July 15th, that calculation will be done that day. So the exact amount of shares that there's going to be landing in people's stockbroker accounts will be calculated at that moment in time. But you can, just to estimate, you can go to First Mining Gold's website, and if you own 1,000 shares of First Mining or 10,000 shares of First Mining, you can type in your holding, and it'll spit out the number of Treasury Metal shares and warrants you're going to get as well. Because you get warrants, which we should have mentioned. These warrants are $1.50 warrants, and they're good for a couple of years. So you get the shares.
Yeah, the warrant is basically a bonus right on top of it. It's an extra incentive. And it's not typically available to a lot of investors unless you're doing private placement deals. So that's a nice little bonus that you guys are giving.
Yeah, we thought it was nice, and you know, it's kind of a promise. What I told you earlier, but we promised that we were going to do something like this, and it's just it's great to see that we're able to do it.
Yeah. Well, Keith, thank you so much for joining the program. We appreciate it. This is a stock we've been covering for a while. We did our first review of it a couple of months ago. I think you are undervalued. I think everything you said is true. I think this is one that our viewers should take a look at and consider for their portfolio, because I think when you guys get closer to producing, your price is going to continue to rise. That's the Lassonde curve for mining stocks. But you'll also have that upside of the gold price as well. And we've been saying we think gold price is very bullish in the next few years as well. So thank you so much for joining the program.
Yeah, great, Robert. And you know, people should go to the website, you know, just firstmininggold.com, and look at the PowerPoint presentation. You know, do your own due diligence, and so on and so forth. But you know, there's a lot of good information on the website.
All right, great. Thank you so much, Keith.
Great, thanks, Robert.
Hey everybody, this is Rob with GoldSIlverPros.com, and I wanted to bring you a very special message from our newest sponsor, that is Kinesis. And the reason we brought Kinesis on to be part of the program is because we fully believe in their mission. Their mission is to have a token that you can trade online that is backed by something of real value. That would be gold or silver. And they also offer a trading platform which allows you to trade through various cryptos and fiat currencies. The great thing about Kinesis is, for those of you that want to store gold or silver, but also have access to it and actually do transactions with it, they allow you to do that. So it's a better option than just flat out storing it. and then having to fly somewhere and take it out when you need it. You have the ability to use it right on their platform. You can send it to other users. They have a debit card for US residents as well, and they have a full exchange, which enables trading of Kinesis currencies for fiat and cryptocurrencies if you want to trade in and out. So lots of ways to get into the Kinesis tokens, the KAU and KAG, that are backed by the precious metals, and also to get out of them and to trade in other things if you want. So there's not this laborious process of getting your gold and silver out of the system. And again, they have a Visa card for US residents, and you can trade these currencies with other Kinesis users, the KAU and KAG, sorry. And so they also have a wallet. So it's a lot like having some of the other currencies you may be used to, cryptocurrency, except for the fact that it's backed. And that's why we wanted to have them on the program. I like the fact that this is backed with something that I trust, that has 6,000 years of monetary history, that is gold and silver, and something that also allows you to interact with the normal everyday financial system as well if you need to get your value in and out. A lot of benefits to using Kinesis. Wanted to share that with you guys. We're so happy to have them sponsoring the program. Look forward to more on Kinesis from us. We are going to do a special profile on Kinesis coming up during the month of June. Stay tuned to that. I'm going to walk through all the benefits of the Kinesis tokens versus other types of currencies, fiat and cryptocurrencies, and give you a full-on review of what I think about Kinesis and what I think the value add is. Stay tuned for that. There'll be a very special video coming up not too long from now.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And this is going to be a quick one because it's just an update on the inflation situation. But a month ago, we got an inflation print from the CPI of 4.2%. Bernanke Powell told us it was transitory. This month, it was up to 5%, a claim it's still transitory. Yet here you see today, U.S. existing home prices hit record high in May. Year-over-year price increase is biggest recorded in real estate group's data going back to 1999. But just wait and make sure you're sitting down. Don't be driving while you hear this. The figure was nearly 24% higher than a year ago. The biggest year-over-year price increase NAR has recorded in data going back to 1999. And given how big a section of the economy the mortgage, construction, and housing market is, if that part's gone up 24% year over year, does that mean it's a little more likely that inflation is actually a lot higher than 5%? That would be my guess. I'll leave you to make your own opinions. But related to the housing market, something I've seen popping up a lot, I keep seeing these stories about Blackstone basically going out